Today is the 27th of February 2021. My name is David Hickson, and in today's market update I'm going to be discussing the clarity that has emerged at last in my analysis of the S&P 500. Before we take a look at the markets, I must ask you to please make sure that you have read and understood these disclaimers. So what do I mean by the clarity that has finally emerged? Well, in my previous two market update videos, and I would encourage you to go back and take a look at them, you will know that I have been discussing two possibilities. The one possibility was that this trough on the 1st of February was a 40-day cycle trough. And the other possibility was that that same trough was a 20-week cycle trough. Now, in my previous market update, which was recorded last weekend, price had just come down and had found some support at the level of the 20-day FLD. In fact, let's zoom in on that. Here we are. So the situation last week was the price had come down and found some support at the level of the 20-day FLD. I know that many people are a little surprised when I speak about the FLDs providing support or resistance, because they expect support and resistance levels to be very absolute numbers, whereas the FLD provides what I call approximate support or resistance, whereby price will come down and often spend a little bit of time getting through that level. And so for a short period of time, a certain amount of support was provided by that 20-day FLD, which we saw in last week's video, because price came down on the Wednesday, bounced off that 20-day FLD, straddled the FLD again on Thursday and on Friday. As some commenters observed, the Friday price movement was a little bearish and was potentially an early warning of the fact that price was going to break down through that FLD. I am not going to repeat everything I said in last week's video, because you can simply go back and take a look at it, but the important point was that we were at a critical point in terms of being able to resolve the magnitude of this trough on the 1st of February. And as I mentioned in last week's video, if price succeeded in breaking down below the 20-day FLD, that would confirm the fact that this trough on the 1st of February was of only 40-day magnitude, and indeed that is what happened. Alternatively, if price succeeded in finding support at the level of the 20-day FLD and bounced upwards, that would provide confirmation that the trough on the 1st of February was the 20-week cycle trough. And so what happened this week, and why do we now have clarity? Well, as you can see, on Monday, or in fact when trading opened on Sunday night, markets were almost by default beneath the 20-day FLD. Now you must remember that this 20-day FLD is a line that has been displaced into the future. And so that line is present on your charts before the price catches up to it, as can be seen over here, because we already have the 20-day FLD reaching about 10 days into the future. And so on Monday, when price did succeed in clearly breaking down below that 20-day FLD, it was clear that price had broken down beneath that FLD, which therefore confirmed that this trough on the 1st of February was of only 40-day magnitude, and that price was now moving down towards the next 20-week cycle trough. And here is the nest of lows for this 20-week cycle trough. As a matter of interest, in last week's video, I mentioned the possibility that this might happen and suggested the low of Thursday's price action as a potential entry point in order to catch the move on the way down to the 20-week cycle trough. And so what happened last week was probably the F category interaction. In a moment we'll zoom out a little and we'll just go through these interactions again, because it's very important that you understand the sequence of interactions. And the way in which I work with the FLD trading strategy, which I should point out is not something that Hurst came up with, it is something that I discovered or invented on the basis of Hurst's work. This regular sequence of interactions between price and the FLD provides us with great insight. Because what happens following an F category interaction in which price does break down below the 20-day FLD is that it will then often come up to the 20-day FLD in what is of course labeled a G category interaction, and that G category interaction is where the 20-day FLD provides resistance to price. Following that time, price moves down in the final interaction of the 80-day sequence of interactions, and it moves down to the 20-week cycle trough. Now, there are some people I know who trade using the FLD trading strategy and do not, in fact, enter at the moment that price crosses below the 20-day FLD. They instead wait for this opportunity over here where price comes back up to the FLD, at which point they fade the move. In other words, they trade short on the expectation that price is going to continue down towards the 20-week cycle trough. Let's zoom out and go through this sequence of interactions, because I think it is important to understand that each one of these interactions has its own characteristics, and when you start to recognize these characteristics, you gain a tremendous benefit in terms of gaining an insight into what's happening in the markets. And so a sequence of interactions occurs following an 80-day cycle trough, which of course was over here on the 4th of January of this year. The first interaction is where price crosses up above the FLD, and that is an A category interaction. That was not a very good, clear A category interaction because price only, in fact, straddled the FLD at the time of the interaction, and it failed to come very far below the 20-day FLD when it formed this 80-day cycle trough. What did that mean? It simply meant that there was still a good deal of bullishness in the market. In a moment, we're going to take a step back and understand why this bullishness is expected to diminish. But at the time, in other words, the beginning of this year, there was a great deal of bullishness, and so our A category interaction was not really a very clear or dramatic one. The A category interaction is expected to achieve its target, which it pretty much did, after which point price is expected to come back and find support at the level of the 20-day FLD at the same time as the 20-day cycle trough is formed. The move down and the point at which it finds support at the 20-day FLD is labeled the B category interaction. The C category interaction which follows is when price bounces back up off the FLD, and here you can see it actually slipped below the FLD over a weekend again, but it very quickly bounced back up again in the C category interaction. The next interaction is the D category interaction, where price crosses down below the FLD. Again, it is expected to reach its target, which it did, and it will reach that target and turn back around as it forms the 40-day cycle trough, which is the trough that formed on the 1st of February. The next interaction is the E category interaction, which of course we've discussed in the previous two market updates, and that is this interaction over here. I have calculated the target in previous market updates, which I think was a little closer to the 4,000 level, and so price didn't quite reach that target. What does that mean? It means that the bullishness of this market, the underlying bullish force of those longer cycles, is beginning to diminish. And that's an important point because, of course, we are expecting that, and we'll take a look in a moment at why we're expecting it. Next is the F category interaction, which, of course, we did see on Monday of last week as price broke down below that 20-day FLD. Then the G category interaction, which, as I've already mentioned, is when price is expected to find resistance at the level of the 20-day FLD. And then the H category interaction as price moves down into this 20-week cycle trough. And so finally, we have some clarity in terms of this analysis. Price is now moving down into a 20-week cycle trough. We are looking for that trough to form soon. Now let's take a step back again and understand why we are expecting the bullishness of this market to diminish. In my previous market update, I took a big step back and I looked at the much longer term picture and discussed the magnitude of this trough over here as being either of 54-month magnitude or of 9-year magnitude. And I would encourage you to take a look at that video because I'm not going to be repeating that information. However, following a very big magnitude cycle trough, which undoubtedly formed in March of last year, What we are looking at now on our chart is the first 18-month cycle that is elapsing following that very big magnitude cycle trough. Over here on the right hand edge of the chart, you can see the whisker, and I think the circle for the 18-month cycle is a little off the chart to the right, but the important point is that towards the middle of this year we are expecting the next 18-month cycle trough. And so what would an 18-month cycle look like on this chart? Well, because we are following the trough of a very big magnitude cycle in March of last year, we would expect a fairly bullish 18-month cycle. Cycles form M shapes in price action, and the center of that M shape would be the 40-week cycle trough, which is over here. And so we can start drawing the M shape of this 18-month cycle. There is the first half of the M shape, which of course completes at the 40-week trough. And the second part of the M shape is over here. We have not necessarily reached the peak yet, but it is possible that we have seen that peak, after which, of course, price will come down and form the 18-month cycle. And so you can see we get a semblance of an M shape forming in the markets. Now, why do I say that the bullishness should be diminishing? Well, it should be apparent that the first half of this M shape, which is, let me clear this over here and draw that again, the first half of this M shape, which is this first 40-week cycle, must by necessity be more bullish than the second half. And by more bullish, I mean that there is a greater increase between the start of the cycle and the end of the cycle than there will be for the second one. And furthermore, the peak of that 40-week cycle is likely to occur later in terms of time in the elapsing of that 40-week cycle, if that is a word, than will be the case for the second peak. In other words, we are expecting this second peak, which has either formed recently or is likely to form fairly soon, that should occur earlier within the current 40-week cycle. Both of those factors will contribute to a gradually diminishing bullishness in the market. And in fact, you can see this diminishing bullishness occurring time and time again. If we focus on the first 20-week cycle that elapsed after March of last year, you can see a very strongly bullish 20-week cycle, which was followed by a slightly less bullish 20-week cycle over there. And here we have seen again a fairly bullish 20-week cycle, and our next 20-week cycle is expected to be less bullish. I'm not going to draw that peak there because my chart limits the amount that it could go up. I'm not saying that the peak that we experienced earlier in February is necessarily the peak of the current 18-month cycle, but that certainly is possible. And so that presents us with a slightly longer term picture, and it explains why we are expecting the bullishness of this market to diminish, because of course the next thing that needs to happen is that the 20-week cycle trough forms. Then we will witness a bounce out of that cycle trough. We will see the formation of another peak. It might be a higher peak or it might not. And then, of course, the markets will turn down and head down towards the 18-month cycle trough expected towards the middle of this year. I do hope that you found this market update interesting. If you have any questions, please put them in the comments below this video. I look forward to hearing from you.